Hi, thanks so much for joining in. You're watching NDTV Profit and my name is Alex Matthew. Exciting times to be an Indian investor, not just because the equity markets are on a tear, but also because the number of options available to you as an investor are going up. I'm talking about a consultation paper that was introduced by the Securities and Exchange Board of India earlier in the week that proposes the introduction of what they call a new asset class, but what you should understand as a new avenue or vehicle for you to invest your money. Now, what they have said essentially is that mutual funds are aimed at the retail investor with low ticket sizes, and PMS or portfolio management services, as well as alternative investment funds or AIFs, are aimed at the HNIs, and that is 50 lakhs and above. That's the threshold that is required. What the SEBI has said is that there is actually a gap between mutual funds and PMSs, which they are trying to bridge by the introduction of a new vehicle. It is yet to be named, but there are a few interesting talking points here, and we'll break all of those down for you over the course of this half an hour. But a few very important points to make at the start. Like I said, this is aimed at bridging the gap between mutual funds and PMSs. It is aimed at the investor with a slightly higher risk appetite. Who can invest? The regulator has proposed a threshold of 10 lakh rupees as a minimum amount, and what the regulator said is that this 10 lakh rupees cannot go below that threshold through redemption. That is, if you invest in something like this, if you withdraw, you cannot withdraw and push the amount less than 10 lakh. If it falls on account of the underlying asset value declining, then that is fine. Who can launch this new asset class, as it is called? Existing mutual funds with a track record of the last 3 years, with a minimum assets under management on an average over the last 3 years as 10,000 crore rupees. And there are a few exceptions to that as well, where if that is not the case and a new mutual fund wants to launch this product, then they can introduce a chief investment officer with an experience of handling not less than 5,000 crore rupees with an experience of 10 years or more. And additionally, the fund manager needs to have an experience of 7 years of handling 3,000 crore rupees. How will this work? Well, it'll work similar to a mutual fund scheme, and this is quite interesting in that you should have the options of investing through the regular routes, which is lump sum, of course, but also through systematic routes, which is the SIP, and you should also be allowed to use the SWP or systematic withdrawal plan or the systematic transfer plan. There are several other proposals that have been made by the regulator, and that includes the per security or sector allocation. And basically what it means is that you can take a more concentrated bet, or you can have a more concentrated portfolio. This is something that was only available with PMSs, which have very concentrated portfolios. Now, to understand how this will work and why this could be a game changer, let me introduce my first guest of the day. We've got Aashish, who's the Chief Executive Officer of WhiteOak Capital, which incidentally has both a mutual fund as well as a PMS. And that's why I think that he's the best person to talk about this right now. Aashish, thanks so much for taking the time. My first question to you is, I know that a lot of comparisons will be made between mutual funds and this new asset class, but how does it differentiate itself, or how will it differentiate itself with the PMS structure?
So in fact, Alex, first of all, it's a, if you really ask me, from whatever I have read or whatever I've understood, and if we are to make global comparisons, I think we should compliment our regulator, because this is innovative thinking, or at least I would say significantly differentiated thinking. Coming to your question about how is it different from a PMS, if you really ask me, what it provides for is variety of risk return combinations, which I would say are even superior, or you can say more riskier than even say some of the PMSs might be doing. So for example, if you look at this new asset class, it is being proposed that they'll be allowed to run, say, short positions. See, till now, you know very clearly that when you look at mutual funds are retail products. They are meant to be conservative and meant to be more, standardized, something which everybody can understand. And the minimum is as little as 100 rupees. So obviously, there is fair amount of risk aversion when it comes to a mutual fund. take an example of mutual funds using derivatives. It's very clear that it can be used only for running a hedged position, right? Or for deploying money in the market and taking a long position. But with this particular new asset class, for instance, derivatives, one can run short position, you can run combinations like long short funds, etc. Now, if you actually look at a PMS, in a PMS, for instance, you're running separate demat accounts for every customer. And let's say you may have hundreds of demat accounts by customer. So what happens for economies of scale and for efficient execution, you end up executing as a pool, and then you allocate all those monies to individual client accounts by the end of the day, which means that transacting in derivatives on a PMS platform is operationally quite a nightmare. So most PMSs actually, if you see, they don't really end up running very many derivative positions. And on the other hand, if you look at mutual funds, there is a clear diktat that it has to be for hedging or it has to be for introducing long positions, but definitely not for shorting, correct? And there are limits to how much you can use derivatives in a mutual fund. Whereas out here in this new asset class, there is a slightly more liberal kind of approach.
That's very interesting, Aashish. And particularly that point, because the rationale that the regulator is talking about is that investors were gravitating towards unlicensed or unregulated avenues to satisfy their urge to make that higher alpha or to generate higher returns. And this is, some would say, going to scratch that itch. Wouldn't you agree?
Yes, because let us say you find, you come across multiple, say, recommendations floating on social media where somebody is recommending a basket of stocks or somebody is saying, invest in this list of stocks or, invest in this, some, variety of nomenclatures that float around. Now, with this new asset class, for instance, you can go up to 15% in a stock, right? Which means theoretically, if I want to run a portfolio of 10 small cap stocks, probably it can be done. And then it would run like any concentrated recommendation or a basket or whatever you want to call it, right? So, and any which way, whatever stock baskets and a lot of the, advisory that is given out, if I'm not wrong, most of them have minimums like 3 lakhs, 5 lakhs, some have minimums like 10 lakhs, etc. So I think the 10 lakh minimum for a new asset class under a mutual fund vehicle, I don't think 10 lakhs is a stretch. And I think you are right in pointing out that, regulated entities, I mean, I would say more tighter, well-regulated entities. Plus, look, all of us have regulated history of 35, 40 years. So, a lot of water under the bridge and the mutual fund industry has evolved a lot. So I think we are probably in a better spot to conduct ourselves when it comes to aggressive strategies, if we are allowed to, which hitherto in a mutual fund was not allowed as yet. So I think the regulator has taken the approach that, look, if investors are seeking risk, nobody can stop them, but then might as well go with something which is more tightly regulated or more experienced in terms of administering than letting them go with other avenues which may be more risk prone.
The way that you've described the operational approach of these proposed schemes, at least the way that it looks on paper, is that they might actually be more nimble than the PMS because of the pooled structure, right? Because it's going to be under the mutual fund structure as well. I'm just wondering, because you've got the pulse of investors across the board, how many takers would you find? Because invariably, I would think that you'd find mutual fund investors over a period of time who have accumulated wealth. And despite the fact that they've accumulated their wealth, they've stayed with the mutual fund industry. Or you have large investors that have PMSs. So one would argue that there are enough opportunities for everybody. And it's not like the mutual fund industry has not been able to generate alpha. It's been very good.
So I would say that, this will pull people from both sides. Let us say, for example, somebody was creating a long short strategy in an AIF. Now, for the longest point in time, tax structure in an AIF, has been a matter of discussion because everything gets taxed as business income and so some of those things. At least my first level reading of this new asset class seems to suggest that it will be a trust like a mutual fund. And hence, it is quite likely or most likely that the tax status will be just like a mutual fund because it's a mutual fund trust. It's just that the scheme composition, you may call it whatever nomenclature and you may say that 10 lakh is the minimum, but the fact is that it's a mutual fund trust structure. So I have no reason to believe that it will be taxed differently from a mutual fund. So that's an example, which means that if there are some strategies which were inefficient from taxation perspective in an AIF, then they should ideally be done in this kind of vehicle. That is one point, where I think some migration of strategies or investors would happen. Second is, there are a lot of people who invest in a PMS because they were anyway direct equity investors. And in a PMS, they like, performance linked fee, zero fee, only variable. So what is possible in a PMS will still be possible in a PMS, and those people may stick to PMS. But let us say if people have been investing in a PMS purely because it is running a highly concentrated small cap portfolio, which a typical mutual fund wouldn't do, then they will be happy to move to this kind of structure, because now this structure can at least to the extent that people were investing in PMSs because they have very few stocks or they are concentrated. I think that type of appeal should move to this new asset class rather than being in a PMS. So that is second use case. Third, for example, if there are mutual fund investors, I think mutual funds will still be the meat of the industry. It will still be the largest part of the industry because relatively safe, diversified. You're looking to run in a stable, consistent fashion. I think a lot of the risk issue nowadays, you're finding very, very narrow sectors and very, very narrow themes being launched in a mutual fund garb. Personally, I think that all should be in the new asset class rather than being in a 100 rupee minimum mutual fund, right? I mean, somebody's launching transportation and logistics fund. I can't think of more than 15 stocks that one can really genuinely buy in a transportation and logistics fund. I mean, now some of those kind of narrow things should be in a new asset class kind of strategy line rather than a 100 rupee mutual fund. So I think there'll be movement from both sides, and I'm quite certain this new asset class will be a big success. But I would still say that mutual fund will be the bread and butter from a longer term perspective.
Okay, the last question, I've so far asked you about things from the perspective of the investor, but also wearing the hat of a CEO of an AMC, and one that has both the options, right? You have mutual fund as well as the PMS. Operationally, will this make sense from you, from a business perspective? And two, what are the cost structures? Of course, this is early days, but what could a cost structure look like?
I think, see, look, when you look at a mutual fund, depending on AUM, there is a graded TER. When you look at PMS also, of course, PMS is a bilateral agreement between portfolio manager and client, but there again, depending on size of application, fixed fee, variable fee, performance linked fee, purely alpha linked fee, there also there are variations in pricing. So I would say that, there is no reason to believe this new asset class will be any different from where we are, generally speaking. In a PMS, people go for variable fee and all, but ultimately, whichever way you count, Alex, ultimately, on an average, people are paying 1.5 to 1.75%, which is what people are paying in a mutual fund also, right? So the market finds its own level, and I don't see how this new asset class will be any differently priced from what regularly we are used to seeing, correct? So I think it will just create new risk-return combinations. Second, more importantly, it will create those risk-return combinations with much better operating platform of a pool structure of a mutual fund, which has been regulated now for very, very long, more than 30, 35 years. I think it's going to be a roaring success, if you ask me.
Fantastic. I got the answer that I was looking for. Aashish, thanks so much for taking the time, and pleasure speaking with you as always.
Thank you, Alex. Thank you.
Now, we've got more lined up. In fact, we have spoken to Radhika Gupta of Edelweiss as well, and we've got that lined up for you after this very quick break. Welcome back. You're watching NDTV Profit, and we're speaking about the proposed new asset class, which, as we've pointed out, is more like a new investment vehicle that is being proposed by the Securities and Exchange Board of India. We had a conversation with Radhika Gupta of Edelweiss Asset Management, and here's what she had to say.
At start, I think it is a natural evolution of the Indian asset management landscape, which started with mutual fund, which is a very constrained offering, and rightly so because it is meant for retail investors. And in the last few years, you've seen the popularity of PMS and AIF products. So, as you said, what is proposed in some sense is a middle ground, although I do believe that much of what you can do on a PMS platform can now be delivered perhaps slightly more efficiently on this platform. So, I think the appetite for new investing styles, new products, new asset classes is evolving. We are seeing that even within the mutual fund business, whether it's factor-based investing, whether it's smart beta, some of these strategies are getting interest on the mutual fund platform. So the Indian consumer, in terms of maturity and in terms of desire for new offerings, has certainly evolved. And so I think this comes at an opportune time, actually. And finally, in terms of convenience, the mutual fund platform is a very convenient operating platform. As the consultation paper mentions, it's an efficient platform. You can do your SIPs. There's a certain set of regulatory comfort and reporting. So it actually all comes together quite well. I mean, I'm genuinely very excited about the proposal.
All right. Hi, Radhika. Very good morning. Now, I'm just trying to understand in this sort of in between, and it seemed like it made sense, right? You have enough and more products for the retail investor. You can start from 150, 200 rupees a day. And then you have products for those who have a 50 lakh rupees and further threshold. Now, something in the middle for 10 lakh rupees threshold. What is the kind of appetite you see for this, and do you see this adding on to flows, domestic flows, in any significant fashion, or is it more of a reallocation which will take place of the same pie?
I think it's somewhere in between. I mean, I think there is some money that. So let's just break it down. I think conventional mutual fund strategies. I mean, of our 60 lakh crores of AUM, 35 lakh crores is in equity or hybrid equivalents, and I think that remains the core of most consumers' portfolio. Let me be very clear and say that anything that is proposed on this platform is more satellite allocation. So I doubt it's going to challenge the existing mutual fund landscape. What I do think it may challenge is the current set of, as I said, PMS providers, category 3 AIF, simply because of mutual fund structure, the ticket size becomes more accessible, the taxation becomes far more favorable, and the operating conditions become a lot better. So I think it is some taking away from the existing asset management pie, and it is some expansion of the market. And the constraints, as I said, are mutual fund plus. So if I give you an idea, for instance, in mutual funds, you can only use derivatives for hedging. On this platform, you can use derivatives to take short positions. In mutual fund portfolios, you can't run concentrated equity funds, very concentrated ones. Here, concentration limits are more open. Here, credit limits are more open. So it's plus plus, rightly so. And I think there is an appetite. I think the Indian consumer has gotten more risk taking. If sold right, this could be a very good step.
Right. Radhika, let's just break this down, right? The reason PMS had a threshold set by the regulator was because these are concentrated portfolios. Yeah. It's not as diversified as a mutual fund is. Now, what you've done is you've created a hybrid model. Sure, the guys with the smaller ticket were doing this in the unregulated market, nevertheless. What I want to understand from you in terms of product launches, is it going to be largely skewed towards long-short strategies, which have become very popular in the recent past, and inverse ETFs, because those are the two that were very specifically mentioned in terms of building out this hybrid PMS mutual fund asset class?
So I think SEBI will eventually, and perhaps not all of this is clear in the paper, but my guess is that SEBI will eventually give categories in which you can launch products. Unlike AIF and to a certain extent PMS, they are open field. So, there is, it is up to the manufacturer to ideate on product category really. For instance, category AIFs have 3 very, very broad categories and a few subcategories. I think here the categories will be a lot more defined, like the current mutual fund universe where you have a large cap and mid cap and it's very clear what you do in each. I suspect it will be much more than the 2 categories proposed. So if in my reading of the document, for instance, there will be some flexibility around fixed income solutions that combine credit, because they also propose things like redemption restrictions, which you can't do on a mutual fund platform. Now that will be very useful if you were to run a credit kind of product. Long short funds is one example. 130-30 funds are very, very popular globally. Inverse ETFs, I mean, these are a few. There's more exemption in terms of holding REITs and InvITs. So perhaps something in the REIT and InvIT space, concentrated equity portfolio could be another option. So I am hoping to see 8 to 10 options come out of this.
Just one more quick question. PMSs usually have a lock-in and, okay, I think Tamanna and Neeraj want to come in. You have a question now?
No.
Okay. They usually come in with a lock-in and a high cost. For a 10 lakh, and that for good enough reason, right? Because you're building concentrated portfolios on a client's demat, and you've got to be far more active in that sense. Keeping that in mind, how will the cost-benefit analysis work out for an investor and also for a producer like yourself? Because this will eat into the pie of mutual fund business and the PMS business that you're already running.
Yeah. So I think from a consumer point of view, this is likely to be more efficient. Now, I don't know the cost structure that SEBI is envisioning, but I assume it is going to be similar to your regular equity mutual fund. So say I was running a long short equity fund on this platform or a concentrated fund. I suspect the cost, rules will be very similar. On a PMS platform, a consumer is paying demat charges. They are sometimes paying performance fees, which are of course not applicable on a mutual fund platform. Most importantly, when the PMS does the churn, they're paying short-term capital gains tax or long-term capital gains tax on each trade. That doesn't happen in a mutual fund platform because there is pass-through taxation. So I think consumers are likely to be meaningfully better off pari passu on product. From a manufacturer's point of view, I think it really depends on the business that you have. For instance, for us, the core of the business is the mutual fund business. Can we, of course, within regulatory guidelines, leverage our existing team, our existing capability to also build products in this new asset class? Yes, we can. So I think for us, it is more operating leverage. If you had a large PMS business, perhaps it could take away. So I think for a manufacturer, it depends on what you have in the setup that you have. But for the consumer, I think this is better off.
Okay, so better for the consumer, more products on the anvil that we will be seeing. Will it be a game changer for the industry, Radhika? Or is it also a way to, I would say, manage all of the derivative volumes in a more structured fashion? If I look at it that way, and in the rubric of the broader attempt of regulators to ensure that people don't get hurt, small investors don't get hurt in the derivative segment, does this also fit into that larger picture?
If that is the intent, then I think it is a wise intent. I mean, I think the regulator has very rightly said for a long time and been concerned about retail investors' participation in derivatives. And, in this way, if funds and professional managers can offer you products that use derivatives to generate returns, and they are professional managers, and those are accessible to you at 10 lakhs. And keep in mind, it's 10 lakhs across all the strategies I offer as a new asset class, right? It's not even 10 lakhs per product. So it's actually quite accessible to the consumer. So if that is the intent and it's part of that larger plan, I certainly think it's a very, very good idea. Keep in mind, SEBI has also put in or proposed very high thresholds, and I think reasonably fair thresholds for who can launch this. If you're a new player, you need a certain amount of fund management experience, AUM that you've managed. So at least they're saying this is for seasoned players. And if it's part of that plan, it's a very good one. Is it a game changer for the industry? I think it's too early to tell, but it certainly opens the industry to more products, and that can only be good.
And that brings us to the end of this special broadcast, and hopefully you have a better idea of what is being proposed by the regulator. And like I said at the start, it's a great time to be an Indian investor. Do stay tuned, lots more coming up over the course of the day. And this is NDTV Profit.